we're saying hello to you from beautiful Orlando, Florida. Our investment committee hasn't been together face to face since last fall. We're here at an investment conference, having a really good time learning about technology and AI and all those things that can freak us out. But really today is just to give you an update of what we're doing in the portfolios and why. But before we get into the slides, I want to introduce everybody. I think you know Jessica Kinnunen, Alan Vandekreek, and our lead portfolio manager, Bob Key. I, of course, am Bruce Reynolds. With that, we're going to dig into some slides that Bob has prepared. We've been talking about them for the last few weeks, but we thought we'd give you a better idea of what we've been doing in the portfolio. So Bob, take it away. Let's go to slide one.
Sounds good.
All right. Bear with me, everybody. Got to get the slides up for you.
One of the big challenges that we all of us face, not just in our industry, but I'm sure you have, and what you do is that we learn certain things in our younger years, going to school, and then we get out in the real world and things operate a little differently. And one of the great philosophies that's out there, and generally widely accepted philosophy, is that a global diversification is an essential part of every portfolio, and that all economies on average form the same. Therefore, a U.S. investor shouldn't just invest in the U.S. A Japanese investor shouldn't just invest in Japan, etc. And as we've been out there, we've challenged that. We've talked a lot about our insecurities around it because we're a U.S. investor that likes the U.S. So we fear sometimes that we may have a little hometown bias going, but yet we keep observing. Not only does the U.S. economy continue to really be the engine of the global economy, but U.S. companies continue to be the engine of global earnings, et cetera. And so you can see here on this first chart, U.S. GDP production. It just keeps chugging along. It's doing fantastic while really the rest of the global economy is pretty much flat or even a little bit negative through time. So a big part of the theme of today's talk is that we've always held less in international securities than global benchmarks would suggest, or less than our peer groups would. But we pulled that back even further as we see growth continuing to get stronger in the U.S. and continuing to be stagnant around the rest of the world. One of the challenges in that is the argument for investing in the rest of the world is that the rest of the world is cheaper. Right? They have lower PEs than the U.S. We see that in the blue line at the bottom. We take the U.S. out, we're only trading about a 14 multiple to earnings, and we the red line being the U.S. we're trading at closer to 23 times multiple. And it's something that a value-oriented investor would say, well, we should be buying international securities because they are cheaper than U.S. securities. And it's a reasonable argument, one that, the value investors of this world have held for a long time. But the value stocks used to sort of systematically outperform growth stocks up until about 25 years ago. And they've gotten really crushed by growth stocks since. And what it's become known as a value trap is there's a reason why the valuation is cheap. We'll see that going on these next charts. The biggest reason why the valuation is cheaper is that their earnings aren't growing. The U.S. earnings are growing. You can see from this chart here on the S&P 500 operating earnings that forward earnings, the 1 year ahead consensus average forecast of all the analysts out there, is that earnings are going to grow again 16% over the next year. So yes, the U.S. has a higher valuation, right? It's considered more expensive, but there's a reason for that because their earnings are growing at a much higher rate than international earnings. Jess, I don't know if you want to comment on this one, but we can just see that, really going back to 2000, before, last 20 years or so, we've really had this is just the U.S. earnings divided by the all world earnings. You can see that the U.S. continued to take up a bigger and bigger percentage on that. And that trend just continues to accelerate as all the big tech companies are coming out of the U.S.
Right. And we actually heard a speaker, David Kelly, who is the Chief Investment Officer for JP Morgan. He actually talked a lot about this today, and about how that big seven is really affecting the market. Do you have any more thoughts on that?
Well, yeah, if we keep going forward on these slides, we'll see that, as a percentage of not just market cap, but also earnings, the U.S., in particular, the tech components are dominating. These are the forward earnings per share of the U.S. You could you could just you could see they are just skyrocketing forward. And if we boiled that down even further into how much of that is due to the big 7, 8 tech company, however you want to count them, it's obviously a huge share of that. One of the misnomers out there is that they say, well, the rest of the companies aren't, their earnings aren't growing, aren't doing well. No, the rest of the U.S. is actually doing fine. It's just not doing as well as the tech, which has just been, skyrocketing.
I wanted to add in one of the things that was reiterated today by Dr. Kelly, but we do it every month. That is rebalance. If we had in your typical 60-40 moderate or balanced portfolio, if we had not rebalanced over these last few years, that 60% equities would now be nearly an 80% portfolio. And that's because those Magnificent Seven stocks have jumped so much. And if we don't sell those profits and get you back into the right mix, whenever they do correct, it will be extremely painful because of overconcentration. So this is something that Alan and I and Jess were always looking into. And yes, we give up a little bit of gain on the top, but I think it's way more important to protect you on the downside.
Another component that's hurt international investing is the strengthening of the U.S. dollar. The dollar has been strengthening for quite some time. If you hold assets in a foreign currency, and that currency is weakening versus the dollar, and you're a U.S. investor, that further erodes your return. That hurts your return. For instance, if a local market, if let's say we bought European stocks, and European stocks are up 3%, but the euro was down 1%, you would only get 2%, not the full 3%. Recently, with the tariffs or the threats of tariffs that are coming on, and that has worked to even strengthen the dollar further. And we expect the dollar to continue to strengthen as we see capital investment flowing into the U.S. Alan, I don't know if you want to maybe help me out on this one here or talk about this one, but this is what I was talking about earlier is when people say, well, it's all being driven by these large cap tech companies. That's where all the earnings are coming from. We see these different forward PE ratios. We also see valuation. When people say it's stretched, well, it's appropriately stretched. It's stretched in that large cap space, which holds the technology stocks. When we get down to the mid and the small caps, they're really very reasonably priced.
Yeah, definitely. And the loftier the PE ratios seem, they can continue to get backed up by record-breaking earnings on a quarterly basis for these big tech companies. So they are justified, even if it doesn't really make sense, on the get-go.
It's a different stratosphere.
Yeah, it's what we call it's like age appropriate, they're multiple appropriate. They're appropriate relative to their earnings growth. Their earnings, if you have enormous earnings growth, you can have an enormous earnings multiple. The rest of the earnings that are more traditional growth rates are at traditional valuations.
Compared to the tech bubble that happened in the late 90s and into 2000, there were not earnings in the tech bubble. And here, these companies continue to accelerate.
So these are kind of, in this one here, it looks like we're talking probably the top 8 stocks. And you could see that those stocks in particular have that high price to earnings multiple. And we're saying the same thing over and over again. What we're doing is we're just whittling it down to a finer and finer number. And we could see, this is what's driving that high multiple that people talk about in U.S. stocks. And again, we find it justified because the earnings are backing up the multiples.
And Bob, I guess I have a question on that. We have a lot of clients who ask, what happens if all of these crash, which we try to say, it would be very unlikely for all, 7, 8 companies to go down. But what are your thoughts on that?
If they all go down, the markets are going to get hurt by. I mean, they are taking up a larger and larger percentage of the market cap of these indices. There's 2 ways for a stock price to go down. There's 2 reasons why stock prices go down. One being that their earnings weaken and they keep the same multiple, right? And the other is that their earnings remain where they are, but their multiples compress. That's the 2 ways for it to go down. I mean, there's no indication as we hit this AI section of the world here that these earnings multiples are slowing down. They're actually accelerating at this point in time. So that leaves us with, if the earnings multiples continue to accelerate, and multiples just stay the same, that's we're going to get to this on the next couple of slides. We spent the last several years being far more bullish than the rest of the world, and we're actually holding our multiples constant right now, which is making us more middle of the pack as opposed to we were on the very high end of bullishness the last couple of years. And this is what I was referring to. Here's 2025's range of forecast. We're right in the middle of that, right around 6,600 is what our forecast was. That's taking that 15% growth rate and just keeping a constant multiple to it. We actually slightly lowered our multiple, so that it brings us to about 12% return as opposed to 15% return. We think that's a fair number. But you can see if we look, that's right in the middle of the range. If we look back over the last couple of years, if we go back and look at go ahead and look at the last couple of years, we've been on the very
Up or down, Bob?
no, we just keep
Excellent.
Next slide. All right.
sorry,
That's all right.
communications. So actually, is this 2024? So I guess slide down, slide down. So this is 2022. 2022. You can see that. Look at how low those levels are on the S&P 500, right? People were extremely cautious, and if we go to 2023, we say the same thing. Yet last year ended around 6,000 on the S&P 500, and if we take a look at it now, you look at where the year ended up. No one was, really anywhere near those levels. The S&P closed at 6,000. And you look at all these big investment banks, and we really don't get joy out of, seeing others, inaccurate forecasts or whatever. We, like I say, we're at the very high end of that range, or our forecasts. We do caution. It's a good way to think about how difficult forecasting is, and that you can be wrong, you can miss things, or quite simply, things can just happen in this world that are unforeseen, right? So that's why we keep you in a diversified portfolio. Yes, we add values for moving asset classes around, and we plan to continue to do so, but we also have to understand that at some level, everyone is prone to having a forecasts that don't quite pan out. So lastly, we talk about this too. Many times when people talk to us about, they're scared about stocks or scared about markets correcting, and you should be. It can happen. The biggest detriment to wealth always has been, always will be holding cash. And this chart's a couple of weeks old now from when we did it. Stocks are up about 70% now over the last couple of years.
I'm going to have you repeat that, Bob, because we have a lot of clients who agree about that
Yes,
right now.
stocks are up about 70% over the last couple of years. And it doesn't mean they won't be down 5% next week.
Right.
But, again, we think about things that really detriment, work to the detriment of gaining wealth over time. We always think about being in the stock market when it crashes. The reality is the worst thing you can possibly do is not be participating, not be invested during over the long period. Investment horizon is the most important concept of all investing. If your investment horizon is more than a year, you should be invested in the markets.
Collectively here, we have over 75 years of investment experience. And one of the things that's so crazy that we've talked about is that really our core job is to keep people in the markets when they're afraid. And it's tough. It's really tough. And of course, the media doesn't usually help. And by the way, they're usually not right. They're really good about getting emotions up and getting panicked. As those of you who've worked with us a long time know, we take the emotion out of it in our investment process. It's proven to work a long time, and it's going to keep working. Anything anybody wants to add before we finish up?
No. We should enjoy this beautiful Florida evening.
All right. Jessica says we're done. As always, you can call us, you can text us, email us if you want us to give you a shout out if you have any questions. But we want to say again, thank you for the trust that you put in our firm, and we're here for you. Have a great day.
Great day, everyone.